questions, one about the $800 billion cash injection, and then also the sector that may be immune to the downturn. It goes back to cash is king, right? Someday we're going to have to pay the piper on this. Putting 800, it's just putting a Band-Aid on it, in my opinion. We got to go back to the 20s and 30s of savings. You know, it's hard to do, but we, you know, so, and then what, I think the energy sector could be immune also.
The question is the energy sector immune? And the second part of that question was, do you want to take back anything that you said and said that the bailout was bad for people? Go ahead, there's an opportunity to do it. Is the energy sector immune?
I really am not very familiar with the energy sector. I'd say the one thing you've just seen in the last 2 months is, I mean, who the heck would have thought that gas in certain states would be under $2 a gallon right now. So it's, I think, you know, anything commodity-based in our business is, you can hire all the consultants in the world, they can give you a 100-page report on this is what's going to happen with commodities. I mean, really, who the heck knows?
Yeah, but we're in a violent deflationary cycle right now, but to your point, long-term, we're likely to be in an inflationary cycle at some point down the road. I don't know how to, you know, predict how that all turns out, but energy is the next great bubble. I mean, that's where tons of money is now flowing in, probably because of observations that you just made. And so there's lots of money coming in there, and there is going to be a fallout, and already is, for some of the ethanol players and other areas. So out of that will be the same kind of internet blow up, and then some good business models, and you'll have some interesting things. Most people think their blow up could be more severe because a lot of the companies don't make sense without tax subsidies, you know, in that sector.
But also, it's not too dissimilar from sort of the telecom services meltdown in the late 90s, where they're so capital-intensive businesses. Once the capital arrives, you may have a great concept, but if you can't get the $300 million to go prove out an ethanol business or solar energy business, it's, you die in the line before you have a chance to prove it out.
And then you got a guy like T-Bone Pickens, you know?
Yeah, and T-Boone Pickens is having a tough time, as you just heard. He's had to pull back on his wind energy after losing about $2 billion. The question right here.
Leah Clavron. After the dot-com bubble bursted, I noticed that there were a lot of specifically technology companies that were very large public companies that were actually doing quite well from a ratios perspective. And a lot of them, a good number of them, went from public to private. What was the reason for that, and when do you think they'll be rolling out IPOs?
Why did the companies that went private after the dot-com boom go private, and then when are they going to come back out and be really good IPOs?
Well, I think that boom's already come and gone, right? So, you know, those companies, and I wouldn't say a lot went private, but some did. But what's happened, though, I think, is you've actually had a lot of companies that, from that period forward to, say, a year or two ago, they had so much cash that was raised that they went way beyond their kind of, you know, what would have otherwise been a natural life for them in the public markets. Those companies now are hitting the wall. They'll go private now. I think you'll see, you know, some emergence of, you know, companies coming back to market at whatever point this cycle has passed its trough. It's probably a couple of years from now, I would estimate.
I say, general, make a comment Craig made. I mean, Sarbanes-Oxley, it makes no sense for any one of our companies to ever go public again. I mean, that's really a last resort right now.
Unless you can make a lot of money on it.
Unless you convince yourself that, but as opposed to selling out to somebody, you know, you deal with all the regulation, all the overhead, all the accounting fees, and you have to be a very meaningfully sized company to one. I mean, the Wall Street research industry is gone. So if you are a $300 million market cap company, 5 years ago you would have a dozen banks that might have covered you. Now there's nobody who will cover you in that industry. If you're not, you know, GE and huge companies, there's not enough trading volume of the investment banks to justify covering them. So you really end up being these orphan public companies with horrible costs and liability to
Did Sarbanes-Oxley kill the public markets and send everyone scampering into the arms of private equity?
I think there's probably 10 factors, which that was one. I do think that these companies that, take it under 300, under $500 million market cap, it just doesn't make sense to be public. You just don't have the float, and the large institutions don't cover you. So I think there was a lot of companies went public that never hit the threshold of being a public company right now. I do think Sarbanes-Oxley, to be honest with you, had a very negative impact on smaller companies trying to go public. Some of those companies maybe shouldn't have been public, so maybe it's done its work, which is you didn't have all these companies that ended up going public in '99 that really never should have been public, and public shareholders lost trillions of dollars in that.
I think that was one. I think the second factor was just an enormous supply of private equity money chasing deals. And third was the very inexpensive leverage that was available that made those deals infinitely financeable and workable.
I'll take one more question, but only from a student. So if you're a student, you can ask a question. Everyone else has to run up afterwards. Are you a student? Yeah. Okay, go ahead.
My name is Joe. You mentioned earlier a little bit about the earnout. Because of the squeeze of available capital, has that earnout period on the seller's part come much longer? And if it has, how much longer? Is it?
Are earnouts longer?
Right.
From the way we look at them, it very much depends on a couple of things. One, if it's a seller who's trying to sell out and really isn't having an ongoing stake in the business at all, he's just along for the ride. We may say it's a longer earnout, or he may want it to be a longer earnout. If it's really a seller who we think is critical to the business and is going to be running it for us, we would, we would certainly try to structure that as a 2 or 3 year earnout and say, hey, let us learn the business, build this business, and we'll go get somebody else new in here. I think a lot of this also goes to just projections. If you're a seller, you're trying to convince us to pay you a price that we can't justify, and you're pounding the table, and these are the numbers we're going to hit the next 3 years. It goes back to a little bit of there's a really way to bridge this valuation gap. If you really believe these numbers, we'll figure out the point of the projections where we think that the logic doesn't hold together, and if you hit those, it's upside for you. We shouldn't benefit from all that upside. We'll share that with you because you were right. So it really depends on but in general, it's just as much as harder to get deals done. I think, bigger earnouts and longer earnouts are probably more palatable to sellers now than they were certainly 18 months ago, where if you mention an earnout to a seller, they say, the heck with that, I got 10 other private equity firms that will pay me 100% cash up front. I don't need to do an earnout.
Well, one of the real advantages to private equity, as you allude to, is to build long-term value. And by structuring earnouts, there are things that can misalign incentives in there. So in a lot of ways, we would prefer, rather than doing deals with earnouts, is to just be a minority investor and to let the CEO and the entrepreneurial team, continue to run their business. The owners of the business took some chips off, at this point in time, and then they get the vast majority of the upside, and we help them get to kind of where they're trying to go. We do earnouts, but I would say that there are inherent conflicts in that you have to be, aware of.
I think there'll be more seller financing.
There you have it.
Definitely for seller family.
Ladies and gentlemen, I want to take an opportunity to thank each one of our panelists individually. From left to right, we had Phil Thompson, a general partner at Alta Communications, and Dr. Craig Francis, a managing director at Summit Partners, and Scott Honor, a senior managing director at the Borders Group. Please thank them. I've been Alex Hayslip. I'm a reporter for the Venture Capital Journal and Private Equity Week. I hope that you'll consider Thomson Reuters products. And, of course, please thank our generous hosts, the